Hello everyone. On behalf of the Finance Club IIT Patna, I welcome you all to our guest lecture series. We have previously done many guest lecture series related to different fields ranging from Prodman to consulting to investment banking, whose recordings are also available at our YouTube channel. Today, we are extremely honored to host with us Mr. Akul Jindal, who is currently working in Venture Highway, a very reputed venture capital firm. He has previously worked at Kalaari Capital and KPMG and is an SSCBS alumni. Today, he will share his insights on the topic overview of venture capital space, starting from very basics to advanced level in a Q&A format with me. He has previously taken many initiatives to share about the venture capital space, which has helped many people, including me. The audience members can raise their hands at the end, where I'll ask them to unmute themselves one by one to ask their questions. Coming to the first question, Akul, can you share about your journey from SSCBS to Kalaari Capital and from there to Venture Highway?
Got it. Thank you so much for having me and asking this question, Madhur. One of the things, and it seems very linear, right? I went from SSCBS to Kalaari Capital, then to Venture Highway. It seems like a very linear journey. But I have to tell the audience here and be very candid when I talk about this. It's not as linear as it seems. In college, I tried starting up. It did not work out. I set up a pro bono venture advisory firm for collegiate founders. That's how I got my first taste of venture capital. And even after college, I spent 4 months in M&A advisory practice at KPMG before I got my first break in the field of venture capital via Kalaari. So while I have been gearing to be a part of this industry, to work in this profession for a very long time, I've had that interest and affinity towards the field and the sector. It is not something that is something that linearly flows from my prior experiences. So venture capital, for someone with my background coming from commerce and Delhi University in particular, is not something that flows directly, right? The thing to, I think, consider or slash a lesson for anyone who's viewing this and giving their time is to continue to express their interest in VC, right? How do you do that? More broadly, you continue writing about startups, you continue reading about them, you start a podcast. The friction to create content today is next to negligible, right? You can set up a Substack in less than 5 minutes. You can start a podcast on Spotify in under 5 minutes. Your first YouTube video can go live in half an hour with all the edits. So start talking about startups, start talking about venture, start reading. First 3 months to 6 months, start reading about what others are saying. Go on Twitter, read others' newsletters, go through podcasts, right? 3 to 6 months of that, and you start to understand, you start to realize how people break down startups, how people learn more about ventures. And once you have that grounding, once you are able to visualize what are the frameworks that they're following, you can use that as a base and develop your own. So that's when the second part of your journey starts, which is creation, right? Firstly, you spend time understanding, and of course, that's a continuous process, right? But the next part is creation. Now that you've learned how to express or how to articulate, you start articulating your own opinions, building your own frameworks to do the same. And when you're in the second leg of your journey, you start to demonstrate interest in the field. And I think this is what worked for me while I was trying to move to Kalaari Capital, which is I had a demonstrated interest in this field, love for startups. I was writing about them, I was working with them, I was trying to assist investors. So all of that flows logically into that one stream of this person eats, breathes, sleeps startups, right? So when you follow that trajectory, you're much more likely, coming from a non-traditional background, to get in venture capital. So that is how, unfortunately, the folks on Kalaari took a chance at a graduate of 2020 with just 1 month of experience actually when I applied. So I owe it to them. I owe a debt of gratitude to the opportunity that they gave me. 6 months at Kalaari, you learn the inside outs of venture capital. I had an outside in view of the industry, how things work, how potentially startups get valued, what are the rationales for investing, right? Then you actually sit at the other side of the table, talk to founders and learn from seasoned investors. And that's, I think, what gives you the grounding. From the outside, it looks like every analyst associate at a venture fund is actually an individual who sits in a position of power, who sits in a position of privilege to be able to adjudicate whether your venture gets funding or not. That is simply not true. I think of the role of any entry-level investment professional as that of a gatekeeper in VC industry. Gatekeeper to just allow or let in some specific ventures that are aligned with your fund, because all that you're doing is essentially acting as a leverage on time, right? The investment committee has X number of members who have a limited amount of time, which is, let's say, 10 to 15 hours a day. But you as an analyst can help them expedite their decision making process by giving them more leverage on their time. You're not as efficient as them, right? They've been in the space for 20 years, you're just starting out. So your job is to give them leverage on their time by supplying them with the relevant information, right? Be it in terms of customer dipstick, be it in terms of market assessment, be it in terms of the depth of the problem statement, all of that. That is what you do as an analyst. And in addition to that, try to figure out who are the relevant founders, in addition to who they're already meeting, who are the other relevant founders you think they should meet. So that is what your role as an analyst or an associate broadly is. And then you also try and support the portfolio founders. You get that opportunity to work closely with them as they build their organization. So that's your role. And that is a very different perspective that you have while you're inside the industry as opposed to when you're outside the industry. So 6 months at Kalaari gave me that grounding. And then from Kalaari, which is, of course, the fellowship is a program which is designed to be more cross-functional, where you're doing or working across investment, research, portfolio support, and PR and media communications. So from there on, it's a 2-year program and it's structured as such for people who are trying to realize what is it that they want to pursue full time, essentially, or what is it that they want to build their career in. I think fortunately for me, I realized sooner rather than later that I wanted to pursue investments and research dedicatedly. So, which is when Venture Highway was hiring. Fortunately, I turned out to be one of the luckier applicants and was able to join the investment team there to dedicatedly focus on the two areas that I believed I wanted to build a career in. So that's how my switch has been from SSCBS to Kalaari and from Kalaari to Venture Highway. It's not as linear and the outcomes are never defined. You just have to keep hustling and take a leap of faith whenever you feel things are right. I switched 3 careers, 3 jobs actually, not 3 careers, 2 careers, 3 jobs in a span of under a year, which is not advisable anywhere, right? But this is a risk, so to speak, that I took. So yeah, you should always know when to jump or how to jump, but you should know when to take a leap of faith.
I think people in general try to avoid risk and see that uh, other people join different fields in a very linear fashion. But as Akul pointed out, there are lots of ups and downs and different trajectories that one need to decide and then move on. So Akul, can you tell something more about VC space? Like what is the need of the VC, or how is it different from other fields, or any certain advantages or disadvantages of this field in comparison to other fields?
So I think there is no um, this is too broad a question, right? which is how is VC different from the other fields, advantages, disadvantages. Actually, let me talk about the archetype of what you'd end up looking at in terms of a VC, right? Different levels, different types of funds, essentially investment stages, and there are different qualities that you look for in investment professionals. But one of the things that stays consistent across the board is that venture capital will always be breadth game rather than a depth game, right? And of course, as you narrow, as you go to a pre-IPO kind of a stage, it does become a depth game to a certain extent. But as a breadth game, at least at the early stages, the idea is that as opposed to you taking a job at a fintech company and working in that one sub theme where you will end up knowing everything, right? You work in an insurance tech company, you're building something for the brokers. So you will know brokers inside out. You will know the insurance tech landscape inside out, right? Because that's your job day in, day out. You're working with them, hustling it out in the grassroots. You're working deep in the trenches. You know it better than anyone else. In venture, um, more often than not, you're taking a very broad view. You're mostly sitting at a 30,000 view of the industry, 30,000 feet view. You're taking that and you're trying to understand what are the nuances of a specific sector. Is this the right mix or not? So, unlike someone who's operating at 100% depth of that space, you as a venture analyst will always be somewhere around that 80% mark. And believe me, the difference between 80 to 100% is much harder to achieve than the difference between 0 to 80%. I think a lot of people here would be familiar with machine learning. And so the progress, right? The data accuracy progress goes like you can achieve 80% in the first 6 months, 90% in a year, 95% in two, 97, 98% in three, and 99% in four. So imagine the kind of difference it will take for you to go from being a VC analyst to having that kind of depth in a sector, right? So there is that depth versus breadth game. So as an analyst at a venture fund, you are playing the breadth game because you'll know 80% about not one, but five, maybe 10, maybe 15 sectors at a time, right? Depending on how many you are tracking at your fund. Whereas in most other professions, in startups, you will know 100% about the industry you're working in. You'll be able to create impact more directly. In venture, your feedback loops are very long because the investment that you make today will likely be liquidated 8 to 10 years down the line, right? So the feedback loops are not that tight. You will not be able to see the impacts of your work for a very long time. And for a lot of people, that is not giving you the instant dopamine hit. It's not like uploading a post on TikTok, right? You're not going to get the instant likes. So being in venture is more like writing a novel where you do tons of research, you put your thoughts on paper, it takes 300 to 500 pages of depth of content, and it may not work out. So, and you won't know that you're a terrible novelist till that book goes out, right? And that book going out takes a long time. So that I think is the difference. It's like being a creator on TikTok versus writing a novel. So that's one. I've already talked about the breadth. The other thing I think, and because there are so many people here, young professionals who will be entering the job market, my only suggestion, humbly, very humbly, I submit to this is to look at places where you can create an impact, right? We have this tendency to look at every step in our career as a step of a ladder, something that will help us get to the next step faster and better. Please don't do that with your careers, right? Always look at your careers as any job that you undertake. That is it, right? Do not consider it as a stepping stone to a higher purpose or a higher goal. Take that job in and of itself as the pedestal that you're on, as a role that you have to succeed in. And that is what will give you learning. That is what will allow you to actually mature yourself in that role. So a lot of people that I know of took consulting with the idea that I'll do consulting for 2 years and that will get me at X place. I will do investment banking for 2 years, that will get me at Y place. But the problem with that approach is that while you're doing consulting, you're never fully invested into the idea of pursuing consulting or investment banking. And that I think is not efficient for you as an individual. what is efficient is to pursue thoroughly and with as much heart as you possibly can every role that you undertake. Only then will you be able to deliver a superior outcome. You can only pursue one thing at a time and deliver the best on it. So pick wisely whatever you do. Venture capital may not be the best career for a lot of us, right? There's VC, there's startups to work in, and within that, there are roles that you want to pick. But if you're, and of course, there are people for whom management consulting and investment banking are probably the best professions out there. I have my friends who've been gunning for these jobs since they were 15. So for them, it's fine because that is their end goal. They're eyeing to be a partner at one of these firms. But if your goal is to get to management consulting or investment banking to get elsewhere, or to get to a startup to get to a VC, please don't pursue that route. Always do whatever it is that you're doing at that very point in time with all of your heart in it, and select your roles not on the basis of where it gets you, but whether if you were doing this. I think one of the rubrics is if you were doing this without money, would you still be happy doing it? Would you still pursue it? And I think that's a good mental model to have.
I think one common question at this point would be like there would be some people who really like doing investing, they want to pursue a career related to investment world, either in the secondary market like the hedge fund or the mutual fund companies do, or in the private market like the venture capital. But usually we see that the structure of these fields is such that generally they don't hire anyone without any either in consulting or investment banking or some other fields. So in that case, in your opinion, what one should do?
I don't think I got that question. Could you please repeat that?
There could be some people who really like to get into the investment field, like they doing investment in secondary market, in the stock market. So related fields could be like hedge fund, mutual funds and similar companies, or even equity research analyst. And there could be some people who really like investing in startups, though they haven't done it practically. So in that case, how they should pursue their interest, because generally most companies don't allow freshers without any prior work experience in either consulting or investment banking field.
Got it. Got it. Look, I think where there is a distinct and in essence what you're talking about is a skill gap, right? A skill gap which is to start out with, there is a lack of access to a specific set of opportunities. Although you want to be pursuing them, maybe that's not available to you, right? I think there what you have to do is have an alignment in terms of where you can get. Because if you want to do consulting, maybe the top three organizations are not accessible to you today. Maybe the next four are, maybe the four after that are, right? And maybe all of them are accessible, but some require you to take that risk of putting or doing an internship for the next 6 months or 12 months. So the idea that I think people should work with is, if this is what you want to do, if there is no full-time role available and you can afford to do that, of course, there are constraints that you have to operate in, right? Everything at the end of the day is a problem where there is a certain set of constraints that you have to operate within. If you can potentially afford to and are that desirous of pursuing that specific role, I think there will always be opportunities that open up. So be it in equity research, be it in consulting, be it in investment banking, if not the top one, two, three firms, it's going to be the four after them, the five after that, the 10 after that, the 15 after that. And if not any one of those, to keep trying to work with them to get an internship. You get that internship and you start working there, right? The other way around is skill gap slash signaling gap, as I would like to put it. I don't think it's that much a problem of skill gap, actually. I think it's a signaling problem, especially in services based industries. So when you're looking at a signaling gap, see what are the signals that you can work on which will give you or get you that same advantage earlier on, right? So for a lot of people who are from tier 2, tier 3 engineering colleges, right? Not your IITs, not NITs, there may be a private college in Punjab, in Andhra Pradesh. What they end up doing is they end up taking the CAT, they go to an IIM, and then they get that signaling value. So that option is always there, but you have to understand when you want to do that and why is it necessary for you. So there are ways to get at every career, right? I was in the same space as every young professional today, trying to get a job back in 2019, right? I was sitting through placements, and I was thinking, look, these are jobs I cannot access. They're not visiting my campus, or they're saying 5 to 7 years of experience. At that very point, a few of my friends, they did not opt out of placements. They sat through everything, right? They were just interviewing to learn what people asked, to prepare themselves better. At the end of it, they actually went to the organizations that they wanted to work with off campus, right? They interviewed with them because while we were hustling it out based on, look, these are the limited set of opportunities that I have access to, they said, I'm going to expand my pool. I'm going to hustle it outside of campus. So the way to start with that is not in your final year. I think some of the placement cells impose constraints because they have to boost their placement ratios and stuff. But what you can do is you have 3 years prior to that. You have to utilize them, especially in BTech. There's also dual degrees, right? You have 3 years, you have 4 years in some cases prior to your placements, where you can actually figure out what you want to do and work with organizations accordingly to get in. Plus, in some cases, maybe what you have to do is you have to, like I said, take a leap of faith. If it's not working out for you from campus and there is no other opportunity, you would not able to make it prior on time, then you take that leap of faith. You bet on yourself to figure it out, and you use that 1 year to get a job in the desired profile that you want to work on outside of campus. So opportunities across the world are always available. It depends on how you restrict yourself. Your college can provide you one set of opportunities to play with. LinkedIn provides you another set. Your network beyond all of these provides you a third set of opportunities to play with. So I think today the opportunity pool is so large that while there are constraints, those constraints are becoming weaker and weaker compared with the access that you have. So those are my thoughts there.
Can you tell more about the different stages of venture funding and the companies that are usually investing in each stage?
So different stages of venture investing, of course, there's early, there's late, there's growth, right? There are all sorts of names, but I think the mindsets are there is a angel to pre-seed to seed and pre-series A cycle. Then there is a series A, series B, series C, and in some cases series D cycle in the Indian market, and there is series E and beyond. So what you have is in the earlier stage cycle, what you're betting on mostly is the founders, right? Which is, are these the right set of people who can build out an organization in this space, right? Can they get early customers? Can they get early traction? Can they validate the hypothesis of the problem that they have? So that's typically your early stage companies or funds operating in that, right? I think that's the second part of your question, if I understand correctly. So I think the lines are blurred actually, right? Venture Highway is an exclusive pre-seed investor, but people who used to do growth investing earlier are now doing seed or pre-seed investing as well. So I do not have a clear answer to where do you draw the line. Axel started with Atoms, which is a pre-seed program. Surge by Sequoia is a seed program. There's also Elevation, which is now doing pre-seed investments. So there is no hard and fast rule today in terms of what funds operate in what category. But series A, B, C, D kind of investors, they're trying to play in a different category where there's more data. The hypothesis has been validated to some sense. And what you're looking for is more stable operators. So people who can now scale these organizations, right? So what you're searching for is not just the founders, but level 2, level 3 organizations. Can they run independent P&Ls? Are they that seasoned? Are they going to stick around with the organization? And in the last stage, which is where typically your private equity firms also enter, like IIFL, Kotak. Thankfully, they've not actually went into a seed pre-seed today, but who knows when that's going to happen. So these organizations, which are exclusively doing your late stage investing, like DST, um, what they end up doing is looking at people who can turn these businesses profitable or who can get them cash flow essentially, right? Because the first few years were burning. Now you're actually looking at monetizing or liquidating your investment. So what you want is people who can actually turn around the business and make it profitable in some sense. So you have also the soft banks of the world operating in that territory. I think we've seen some meltdowns in the public markets recently with what has happened with Paytm, with Zomato. But that's essentially what the late stage folks are expecting. Idea is how do you turn around a scaled business profitable, and how do you make it valuable for retail investors? So I think that's the last leg of that journey, which thankfully today still has exclusive investors like CPPIB, which is the Canadian Pension Investment Board. There's the Qatar Investment Authority. There is Khazana, I think, which has not been actively deploying capital of late. But all of these generally your sovereign wealth funds like Temasek, Tencent of China. These guys are operating exclusively in that domain and they continue to do that. Rocket Internet, there's DST. The Series A to Series D kind of play, the names people hear mostly are Matrix, Elevation, Sequoia. Um, there's Axel, right? But of course, they're doing multi-stage now. So you can't really pinpoint and say this is what these guys do better. Kalaari was comes in that Series A kind of a range. So yeah, this is essentially a fund demarcation, and with venture highway actually with much lower checks than us, you have Titan Capital, Better Capital, there's Axel or and a lot of other funds playing in the same zone as us. So and of course Series B, C, D, there's Norwest, there's Trifecta, there's a vendors growth equity. So there are a lot of funds across capital across these structures, right? There's TVS Capital as well. So what you have to be mindful of is the strict delineations that used to exist, they don't really anymore because everyone is going one step prior. Essentially, if you understand Series E, you'll say maybe I should do Series D as well because you know I'm great at Series E. I understand how businesses work. Maybe I should do Series D because the timing is not that different. The stage is not that different in terms of maturity, but the returns are, of course, much better because you're assuming more risk the earlier in you come in. And you went from Series E to D to B, C to B to A to then seed. So you can continue going in that trajectory. I don't know where this stops. But frankly, the idea is there is no strict delineation except at the post Series D kind of stage where startups are turning unicorn. So thankfully, there's still some demarcation there, but let's see where the industry goes.
How is the typical day of an analyst or associate in a venture capital company?
Sorry, could you repeat that?
How is the typical day of an analyst or an associate in a venture capital firm?
Got it. Sure. So typical day of an analyst associate in a VC fund, mostly you're meeting founders, right? Most of your time, that's what you end up doing. Idea is that you have to, like I said, you're a gatekeeper, right? You have to meet with founders and see whether it's worth their time to actually engage further with your fund, right? Whether they're aligned with your thesis, whether there is an opportunity for you to work together or not. So you're trying to work with them to understand that. Most of your days, 40 to 60% of your time consistently goes through that. Another 20-30% goes in supporting portfolio companies in what they're doing, right? So hiring, being a sounding board, um, doing their PR or anything actually that they need, right? So at any given time, you may be working with 4 to 5 portfolio companies. So the time coordination goes there. Then there's 10-15% of your time that goes in ad hoc stuff, right? So which would be, let's say, doing something for your own fund, right? So not every time you're sourcing your own deals. Sometimes you're assisting other people, right? You're assisting a partner or a VP or a principal who has a deal, and you're assisting them with sector knowledge, sector research, or customer dipsticks or anything like that. Making financial models, doing valuations, competitor benchmarking. So there's a lot of things that you do, but that's mostly a part of the support function, which is more or less ad hoc. There is no linear allocation of time there, right? So it may be there on one day, maybe that one day takes up the entirety of your time and you're doing sourcing the rest of the week. So it depends on how you interact with that.
How one can do a good deal flow and also a better due diligence for a given startup in general.
Um, I don't think that there's a specific answer to this, to be honest, right? To this question. So how to get good deal flow? Everyone has their own ways to go about it, which is some people choose to write about the specific sector that they're investing in. And then, of course, once you see that this is a fund that is looking for deals in a specific area, then what happens is that people who are building in that area may reach out to you. And so there's that fit that happens, and then you have a conversation. So that is one way to look at it. But honestly, this is more art than science. There are deal flow mechanisms that work for people differently. Some people do it more on a relationship based method, right? Which is people from a specific college, if they're raising, they have to come to you, right? I think there's enough markers to say that if people come from a specific organization, a specific college, or maybe a specific type of background, right? Then there's a specific fund that they go to, or a specific fund that they find alignment with. So there's a lot of those things that happen. But mostly it's about what kind of networks or relationships you want to build. The one thing that continues to consist slash compound is to continue writing slash creating. So if you write enough, if you do enough podcasting, maybe vlogging around the sectors that you work on, I think that's most fruitful in terms of getting deal flow, because that as a consistent mechanism will continue to compound with whatever you're doing otherwise, whatever networks that you already have. So that's a constant activity. Everything else is more passive. Graduating or being from a specific college or a company is something that passively stays with you throughout your life. So that's not something that you have to actively work on as much as creating content and showing that sector alignment and depth of knowledge in a specific space.
How important it is to analyze the target market for a pre-seed slash seed stage startup in a proper way, apart from focusing on the uh, team of the startup.
Got it. So here's the thing, right? And very interestingly, Sajid Pai from Bloom Ventures wrote this very recently. He said he passed on investing in White Hat Junior because he did not think of how big the market was, right? He did not have visibility into it at that point. I think what you're looking at more so than the exact market size, right, is is this something that exists as a problem? Is this the optimal solution? So the earlier you go, it ends up being more around the founder. And in the market, there are a few questions that you have to ask, which is this going to generate enough ROI for a consumer in terms of resolving their pain point? If that answer is yes, right? And then the second part of it is, can you then tie it into being able to get money for this service or product that you're offering, whether directly or indirectly, right? If it's a attention span, what can you do with that? So market size is important, but I think it's also something that we have to be cognizant of, that markets may not be visible, right? There is this company called Apps for Bharat. They have this app called Shri Mandir, where essentially you're praying to a deity online, right? So typically everyone's thought, COVID has happened, SaaS for mandirs is important, and people start building that. that, you can see the pujan live from a specific temple. And that's the approach everyone else took. But what this individual decided to do, or this team decided to do, was why don't we take that entire devotional behavior and try to productize it via an app? So today they have things like Punya points, which is Snapchat streaks, right? But every day you open the app, you get Punya points, and each Punya points gets you closer to heaven. So the idea is that product providing enough ROI, right? And ROI is not just in terms of monetary value, but in terms of solving or addressing a latent demand. Nobody knew this was a demand, right? Everybody knew that something had to happen in the devotion space, but not how it had to happen. So this, I think, gives you a sense of the idea is to look at the founders, their ability to figure out a solution to a problem, right? And that the problem has to have depth, right? It can't be a long tail problem. It can't be that there is X% of people, let's say there is 0.1% of people who are facing this trivial problem of um, the nibs of their pen breaking, right? It makes you feel terrible at that one point when it does and you have no other writing instrument, right? But, or for example, some of the products that we saw in Shark Tank India as well, some of them are very valuable individual products, but you cannot build a large outcome from there. So the idea is to not get bogged down by market size, but to be cognizant of it. So I think it's important to be aware of the depth of the problem, the breadth of the problem, and how much ROI can your potential solution create for the users, or the founding team can actually build anything in that category. So early stage founders also pivot very much while finding their product market fit. So idea is, if they're good founders, if it's a large enough market, or if it's a small market but that's growing very rapidly, like BNPL for instance, you want to be going in and riding it out with them honestly. So it's founders always first at early stage, then there's market, and then there's the solutioning, because they all can change in that order.
Can you tell something about startup valuation at different stages from pre-seed to Series A to Series D?
Got it. Got it. I think, look, valuations change because in the early stages, the idea that you're working with is how much money is needed, right? It's more coming from a space of I need X amount of money to get it from stage 0 to stage 1, or stage 1 to stage 2, or stage 2 to stage 5. But when you grow at a later stage, while that still continues to be a consideration that this is the amount of cash I need, then you actually have some fundamentals based on which the company can be valued. As an early stage startup, although there are ways to value organizations, and there is some work that has been done on this, for those of you interested in going that deep, look at CFA level 2 alternate investments curriculum. They have explained it beautifully in terms of venture capital returns. But broadly speaking, at the early stages, it ends up being how much amount of capital is it that your enterprise is going to need for the next 18 months, or maybe some buffer, and you talk about it for 24 months. But as your organization grows, then you kind of start tilting the scales towards the valuation of the company from the need of the company. And the valuation of the company is how much can this business be worth, which is your typical discounting cash flows, right? You start discounting cash flows, probably let's say at a Series B kind of round, and you're trying to analyze, okay, this is where this organization can grow if I were to invest X amount of capital, and these will be my returns. So as businesses grow, the tilt from cash requirement to valuation of a business continues to shift in terms of the scale. But yeah, I think that's the broad idea around which you operate. The more data you get, the more analysis you can run on it, typically, right? So at an early stage, pre-seed, seed stage, you don't have data. As you go through Series D, you get tons of data, you get tons of fundamentals. The organization has some legs to stand on. If it's a SaaS company, nothing like it, because you have customers who are paying you a recurring sum of money, right? So you have legs to stand on, you have bases to form, and then you can talk about expansion and stuff. So it tilts from requirement of cash to valuation of the organization as you grow longer and longer into the cycle / stages of a startup's valuation.
How does venture capital firm take the exit decisions? Like after each round, their equity dilution happens due to subsequent funding. So how they decide whether they should exit a startup at let's say seed D or seed E, series D or series E round, or they should wait if the startup can ultimately go to the IPO.
Okay, so I think that's an interesting question, right? Typically, consumer businesses we have known over time have required lots of influx of capital, right? Which is, if you look at every consumer business and you look at the amount of equity that the founders have retained at the end of it, of course, Zerodha continues to be an exception. Zoho in the B2B space is an exception, right? But typically, there is larger amount of capital that is required to get consumer businesses to scale. On the other hand, if you look at your B2B / enterprise SaaS businesses, they'll start becoming profitable much sooner. Today, we have the cases of Infra.Market. We have the case of Razorpay most recently turning profitable. And I think that's a trend that is very visible for an obvious reason, which is it's harder to acquire a larger number of customers and build a business on top of that. And the valuations reflect that, right? So your B2C businesses like Flipkart, like Byju's, they are way more valuable than a lot of your B2B companies, right? Because of the scale at which you can operate and the wallet share that you can capture. Of course, there are nuances to that, but because you have to acquire a larger number of customers, it requires significant investments of capital. So you have to be thoughtful about how much dilution there is going to be across rounds, and you cannot have that answer with you. But what you're hoping for, in some sense, is that if you start out with a 20% today, you want to be at least a 5 to 8% kind of shareholding pre-IPO, right? Because let's say you own 20% at a 5 million valuation, where you want to be is at an 8% at a 5 billion valuation. So that's what your 5 to 8%, that is what you're hoping for. And that's a good enough, I think that's a 250x in the worst case, 400x in the best case kind of a return, right? So if you had $100 million fund that has returned your fund, that investment alone. So that's what you're hoping for, which is if it's a $1 billion outcome, depending on the type of the business, how much dilution is it going to take for me to get from here till that point of exit? So it's different for different business types. But generally, what I've seen in my limited time here is that consumer businesses end up requiring larger amounts of capital. And of course, dilution hence is higher.
Can you tell some differences in the approach of angel investors in comparison to early stage VC investors?
Hmm. Um, I think the difference is that as an angel investor, when you're cutting a check, right? And there are nuances to that, which is 2016 and earlier, 2016 and post that. After 16, we've had a lot of people get exits because I think Flipkart's acquisition happened around the same time. So a lot of people had liquid cash exits. Free charge also happened. So Kunal Shah got his exit. Mintra happened. So a lot of these initial early days founders, they got their exit. So I'll divide this into two parts, right? Earlier 2015, 2016, prior to that, what used to happen was, as an angel investor, you were very conservative about the kind of businesses you were participating in, with the idea that now that you're cutting a check for this business, you will be able to help them significantly grow because of how involved you will be in the business. So that used to be the idea you operated with. Then you came to the second leg of it, which is your post 2015, where now early stage founders have a lot of risk capital, right? So what they end up doing is that you can afford to take more riskier bets, more riskier positions. And so it may not be that you want to be significantly involved in the business, but because you have these large amounts of large pools of risk capital, you can continue to deploy them. So which is what we're beginning to see, right? There are angel investors who have portfolios of some 200 companies, right? And that does not happen unless you have a much larger risk taking appetite. You're not giving them individual attention, of course. You're running your own business as well. So I think the way angel investing used to happen is different. Now, how VC is different from angel investing is that VCs typically will have larger pools of capital, right? Because we have much larger funds, and individual is only getting, let's say, 10% of their investable capital as a part of that risk asset class, given the high risk that venture has. Whereas a venture fund is designed exclusively to do deployment in this class. So that broadly becomes the difference. Angel investors have to um, be, in some sense, more considerate because it's their personal capital, and they're more. It depends on their risk appetite. But as venture investors, since you're coming with the idea in that class of investing, and your decisions are more structured around taking a portfolio approach while you're trying to build this out. I think it's a very different mindset that you operate with, right? So I think in terms of the asset class, venture investors are doing this full time. So there's a difference there, a lot of difference, and angel investors are doing this part time. So the amount of diligence that goes into it could potentially be very different. The risk assumption could potentially be very different. So yeah, that's there.
Can you elaborate more about how a fresher can enter into this space if one is very interested?
Right. So I think I threw some light on it, right, which is to produce content or show your interest in the space, right? The other, of course, is to intern with organizations in the space, try to work with them, try to work with their portfolio companies, leverage that network to get in. And the best way to for a fresher to enter is to not wait till your final year. It's start working on this as early as you can, which is the moment you realize that venture is where you want to be or startups is where you want to be, you start interning, at least you start writing, you start working on the avenues that you have. I think today, at least, there are just way too many options, right? You're spoiled for choice in some sense in the way you want to enter into venture capital. There's organizations like Grad Capital, or which is allowing people to be student associate partners. There's the Campus Fund, there's Hostel Fund, three of these organizations. Then the organization I founded, Red Herring Ventures, we are working with a lot of um, students, right? Currently undergrad students, so that we can help them out break into venture by training them on thesis development and stuff. So there are just too many options like this. Plus, you have the independent option of starting or producing your own content. I think there's a lot of content series out there as well today, right? There are people whose content is being consumed more so than your traditional media outlets. So the idea that I will leave you with here is that you have to carve out your path of working with startups or venture. There are ample of opportunities or ample of avenues. It's up to you which one you particularly like slash wish to pursue.
What is the general shortlisting process followed by a VC company?
What is the general soliciting process?
Shortlisting process.
Shortlisting process. All right. I think there's no. It's mostly what you're trying to do is um, looking at businesses that fit your thesis. I think that's what you're broadly trying to do. And founders that you can add most value to, right? So I cannot generalize this for other funds, but I'll talk a lot about Venture Highway and the process that we work with, right? Our idea is very simple. Is this a business that is a part of our thesis, or is that something that we believe in, right? It is something that we believe we can add value to. So that I think becomes our first funnel, which is, let's say if there's a hardware tech company, we at Venture Highway do not invest in that because we do not understand that space well. So our idea is if we're not able to add value beyond capital to an enterprise, we'll not work with the founder because capital is available a plenty across the ecosystem today. So that's the idea that we work with, which is this something where we can add value beyond capital? If yes, will this founder enjoy working with us? Right? And so there are a lot of those layers of those questions. And of course, the idea is not just while the founder is trying to evaluate us in terms of whether we are the right set of partners, whether it will work that way. Our idea is to be as transparent and as honest with the founders in terms of how we work, how we operate, to see if there is a fit there. So I think the idea of shortlisting more revolves around having seen so many pitches. Is this the type of organization slash enterprise that we can contribute a lot to, right? If yes, then we pursue it. If not, then the idea is to drop it there. Then there is conversations where we are trying to explore each other as partners, which is would it be a great idea to work together, right? And it's the same thought process, which is could you work, could the founders work with you for the next 20 years? So you're giving them that answer or that visibility through multiple conversations. And at the same time, you're trying to assess your idea of the founders themselves, which is, are they passionate? Are they resilient to build in this category? So it works both ways, right? Which is that's the idea of having these conversations.
How important is having some kind of past entrepreneurship experience before entering into the VC space?
Uh, I personally consider it very important. I don't know how other people look at it, right? But what my personal opinion is that as an operator, I think you develop a certain empathy for founders, right? Being on that side of the business, which is very difficult to develop as an investor solely. While over time, and I think it's a signal of early empathy versus late empathy. Because you were a founder, you are very early on able to empathize with another founder, to be able to recognize them, to be able to help them out. Whereas as an investor, you have to work with your portfolio founders for a long period of time to develop even an X% of that empathy. So being an entrepreneur and being an investor directly, that's there. And the second part of it actually comes from, if you are a founder because you built in a specific sector, right? You'll have a lot of depth in that sector. That also means that there will always end up being some biases around that sector in your head, which is this sector is difficult, it will work a certain way. So when a founder is pitching you a different way of building in that space, maybe it's difficult for you to change your thought process because you did that for 10 years or 5 years, whatever that time period was. I think there is a very good podcast by Matrix on this actually, where they've broken down the founder investor archetype versus the investor archetype essentially. So people who've been in venture all time, people who switched from being founders to funders. So I think they've articulated it beautifully, which is there's bias and there's also empathy. So it depends on that. There's no one right answer to it as to pretty much everything in venture. But the idea is this is the difference broadly that remains.
What could be a good pathway if an undergraduate student wants to start his own venture capital fund after some years? So, like after his undergraduate, what options should he choose which may help him to start his own venture fund? Like, for example, should he work in a startup for some years related to operations role, or like a prior entrepreneurship experience, or work experience of analyst slash associate in some venture capital fund, etc.
Okay, so all of those are good pathways, right? There's no best pathway. Like everything else in venture, it's more art than science. Idea that you have to again work with is look, select, like I said, right? And I'll tie it back to the previous answers that I've given. Um, Select the kind of venture or the kind of opportunity that in and of itself, as it stands, works best for you, right? Now, knowing that this is the best opportunity for me at the moment, you work on going from there to the next step, which is do not think about the next step first. Setting up your own fund, there are people who have done it with different backgrounds. Being in a startup in an early stage role, probably where you have enough equity, allows you a large enough exit. Maybe you have more capital and you can set up a fund. Being an analyst or an associate at a good fund, maybe you have a good track record that allows you to set up a fund. So the idea is you have to choose what your career is, and from that you have to take the next step or the next logical step into setting up a fund. There is no one right answer as to what gets you to set up a fund.
Can you share any recommended resources that would be helpful for people looking to enter into VC field to enhance their knowledge?
Got it. Uh, Recommended resources, go on Twitter. I'd say just go on Twitter. There's a lot of noise there. Okay, there's a lot of noise there. But I would say that on Twitter, there are enough good people who are writing about the Indian venture ecosystem, and you should continue reading their tweets. Right. Then one of the more interesting books slash playbook has been published by Sequoia actually on their website on venture investing or starting up in general. I think that's a very good resource for anyone to start with. And yeah, you have your traditional Your Story in 42 to just stay updated. But I think for knowledge, Twitter works better than everything else because you have a lot of people trying to build their brand there. And because they're trying to build their brand there, they put out more content more frequently and it's more valuable. So as long as you can stay away from the noise, as long as you learn how to tune out the useless stuff, I think there's nothing like Twitter to get gyan on venture.
What are your favorite 2 to 3 sectors that you like to invest and why?
I think I have a very founder first mindset, right? So anything that a founder is building in, as long as I can have the privilege of partnering with that founder, that's going to be on priority for me. I do not understand Web3 very well, so that's a caveat for me. Right, I'm still working on that. But beyond that, any founder building in any sector, please always reach out. Happy to chat.
What is your biggest practical lesson learned related to venture capital space?
Got it. Biggest practical lesson is it's much harder to be a founder than you will ever learn from the outside. Actually, let me rephrase that. It's much harder to be a successful founder than what you will see from the outside. You are, and let me just put that in perspective, right? You're trying to create a 10,000 crore company in 7 years, which is about 1,400 crores of value being created every year. So about 4 crores a day, roughly 4 crores a day. So that is the kind of wealth you are creating. So it's a lot harder than just registering a private limited company and changing your designation on LinkedIn. Right? Being a founder is like running a bamboo farm. First 90 days, you're not going to see anything. But after that, it's going to take shoots and just grow to 5 meters tall. In venture, as a founder, I think, or I've heard so far, um, it's not something that people realize. So just be resilient, continue persevering, and you never know when that moment is going to come for your startup, but it will, hopefully. My best wishes. And when it does, it's a good problem to have. But otherwise, it's very tough being a founder. It's not as easy as a lot of people might have made it seem. So yeah.
Can you name some of those accounts on Twitter either individual investors or some venture companies whose writings you usually like, whose analysis or whose insights?
So I read a lot from Sajid actually. I think he was writing great threads early on. But honestly, if you follow Indian startup Twitter, you never know who's the or where is the perfect content going to come from at any given time, right? There's no one source. So yeah, that's it.
Now I think audience members can also ask their questions by raising their hands one by one. Or alternatively, they can comment their questions also. Ishan, you can ask your question.
Hi, am I audible?
Yeah, you are audible.
Hi, Akul. Discussion. Learned a lot, made a lot of notes. This is pretty cool. What I wanted to ask was one, you mentioned something regarding CFA level 2 alternative investment framework. Would expound on that. And second is when it comes to deal flow, it often seems like the one advantage that really differentiates a VC firm from any other is the kind of deal flow that they get. Like sometimes it seems to me that it is like a snowball effect where Sequoia, being Sequoia, gets the best deal flow compared to somebody who's just starting out. So how do you combat that in terms of deal flow? Thanks.
Got it. Okay. Um, let me actually contextualize this. Ishan, if you could help me a little bit with your background, etc. I think that would be helpful.
So right now I'm in Bangalore. I'm done with my degree as such, and I'm applying for Kalaari and all these firms in Bangalore. And as such, like I have a love for venture capital, which I feel is like uniquely like I track everything, I read everything that comes out on venture in India. So I'm applying for these firms because I want to get into a venture capital fund with the intention of starting my own in like 3 to 4 years.
Got it. Okay. Cool. I think this helps. Let me try and contextualize this for you then. Um, I think see what in terms of deal flow and how you get access, right? I'll start with that part of your question, which is yes, different funds do get different deal flow, and that deal flow is what actually, in a large way, contributes to the kind of outcomes that they're able to um, build towards, right? But for a new fund, what are the ways that you can work with on getting deal flow, on being able to source? So what you have to do, I think, and what the best alternative for you there as a new fund, as a new founder, as a new investment manager, is actually to find your niche, right? Why, which is the same as a startup. Why do you need this startup? Why do you need this organization to exist? Same question, ask yourself as a venture fund. What is it that you bring to the table that does not exist today, right? If you are just another pool of capital with the same offering as anyone else, why will anyone come to you? So that's a question to be answered. If there is anything that's even slightly differentiated in your offering as a venture fund manager than everyone else's, then you have to position yourself as such, which is maybe you're a minority investor, maybe you do not absorb as much equity, maybe you do not take a board seat, maybe you are a hands-off kind of a player, and maybe that's what people in a specific sector need. So, in my opinion, there are three types of axes, two axes actually, three types of fund archetypes that will continue to proliferate in the ecosystem. One is the large fund houses, which is, I'll take the examples of the US, which is A16Z or a Sequoia, right? Then you have the smaller ones, which will be based more on a function slash a sector specification, which is you have people who are just doing fintech investing. You have people who are doing just tech investing because they understand those sectors that deeply and can help you build the right set of partnerships early on to blitz scale. And the other is from a functional perspective, which is people who understand marketing or HR or tech so well, right? Which is your deep tech funds, or people who are, or there's a fund in the US which is all product managers. There's a fund in the US which is all in all corp fin guys, right? So what they're helping you is structure your cap table in the best way possible. So you have to have that identity for yourself. And I think there's going to be these three types of main funds over time as fragmentation sets in. So that's where the ecosystem is going to head towards to talk about deal flow. So that's where you have to identify a white space and build a fund in. Is this something that exists? Is there a fund that's needed in this category? If so, you are going to start getting that type of deal flow. We've seen that happen, and I think that is something that will continue to compound.
Just as an add-on, do you think, like when you said that content is a way to compound, like your network, do you mean in terms of like all the US examples I know of, right? Like Morgan Housel, who got into collaborative fund because of his writing, and then you have also the example of Sahil Bloom or Harry Stebbings of 20 VC. So did you mean that as an example of, okay, content creation will help you get that network, get you that exponential like access better than any other, like just a passive fund as such?
Okay, so I think two parts to it, right? What Harry Stebbings, etc., they're doing, that's a different game. Um, but partly yes. What I meant was in the from a compounding sense, what I was talking about is not access slash visibility, right? Harry Stebbings today has the kind of visibility that probably a lot of other funds don't because of the kind of content that he's doing. Um, what I was talking about is putting out your sector depth slash your affinity slash love for a specific space or your knowledge of a specific space. So I'm talking about going not more from a PR lens, right, which is podcasting in that fashion, but more going from a knowledge slash writing lens. When you do that, I think that is something that compounds more in terms of establishing you with as someone who has depth in a specific vertical, right? Like I highlighted two of those, which is there a functional depth that you bring? Is there a sectoral depth that you bring? Harry Stebbings and Sahil Bloom and a lot of these, they have their own ways, they have their own PR. But if you look at it, what they are trying to compete with is not these two archetypes. They're trying to compete with the broader funds. And the challenge there is that those pools of capital are so large that you will never actually get that access. So because of those pools of capital being large, there is this effect of great founders always chasing those pools of capital before they come to you. So that is very difficult to compete with, in my opinion.
That's the snowball effect, right? Like
Yeah.
in a way, Sequoia creating its own, the brand creating its own snowball.
Yeah, absolutely.
Okay, and just the small side being, you mentioned something regarding the alternative investment framework in CFA level 2. Could you just tell me a little bit more? Like, what should I read specifically in that? For what exactly?
Yeah, so CFA level 2 alternative investments, they have this venture capital returns model, right? So typically this is not something you'll find anywhere, but I think they've articulated it very well, which is how do you value startups based on some other metrics. So people generally read the first Chicago method, the Berkus method, the scoring method. I think they're all not up to the mark, but the way it has been drilled down and presented in the CFA level 2 curriculum, I think that's worth spending your time on. The other way to get the same outcome is, I think, it's either SDA Bocconi or Yale. They have a course on the fundamentals of private equity venture capital. They're also teaching you about returns and how valuations work out in the space. So it's the same curriculum. They're doing it in a video bite-sized format. So yeah.
Okay, thank you, Akul, so much. This was really cool. This is really awesome. Like, that is amazing. Like, 1 hour, I've learned more than most of these Udemy courses promise and all of that. Thank you so much.
Pleasure.
Coming to the next question, Akul, can you share like any different ways? How do you learn about some new industry in which you want to know more about? Like suppose, for example, about Web 3.0 or NFT or gaming industry. Like how one can find some resources to learn more about those industries?
So I think one of the best parts about being in venture is also that you have access, right? You have access to a lot of people that others may not, right? And when I say that, I'm talking in a sense of as a fund manager, there is a certain experience that the partners bring. There is a certain pedigree that they have, due to which we can access a set of people who are building the frameworks. So when it comes to crypto, right? Of course, Web3, there's enough writing out there because people are trying to actually educate others, right? With white papers, with their podcasts, with the events, everything they're trying to do very actively to form that worldview. But otherwise as well, if I have to learn about gaming, there's enough knowledge today that's been democratized. But on top of that, being in venture allows you access to the best people in the ecosystem who are working on that as a problem statement or have deep awareness. So you work with them to get deeper understanding, and that is a privilege of being in venture. So you can expedite your learning or learn about a new space very quickly because you have to do that to be able to make decisions and write checks in companies.
Is there any other question from anyone from the audience? I think Satyam also raised hand earlier, but I couldn't see him. Or any other people?
Yeah,
Any questions?
hello Madhur. Yes, very good afternoon, Akul. My question was almost similar to what Madhur asked right now. Because we as a new investors and are looking for new opportunities in the market, so that we can like in 2 or 3 years we can grow our funds and then we can establish something better. So in that case, I want to ask you that whether in putting our money or something like that into a new space, a very new space like the crypto industry and all, would be a good option or not?
I'm
Like
sorry.
because that's very
Investing
risky
in,
and
are you talking about
from the
investing in crypto or learning in crypto? I'm not sure I understand.
yeah, I'm talking about investing in crypto
So
because that's yeah. Thank you.
So there are people who say that investing in a category is the best way to learn about it because when you have your money riding on it, you're more attuned, right? You try to learn more because you have something, you have some skin in the game. That's the only logic. But otherwise, I personally am not invested in crypto and I do not intend to do so. Plus, I don't think I'm the right person to be guiding anyone. I'm still learning about the space, quite honestly.
All right, thank you very much.
Any more questions from the audience side? Yes, Mohammed Faisal, you can ask your question.
Awkward. Uh, it is a really nice, nice amount of information that we are getting from you. I'm really thankful for that. Like, I would really like to ask you that there is a lot of information out there about these resources, and sometimes what happens is that it would be better if we could be capable of deciding what is noise and what is information. So, how would you help us on like how would you put the light on that part?
Okay. Look, here's the thing, right? That there's the way to sort out between the noise, etc. is not something you develop in one day. It's something that you develop overnight. Sorry, it's not something you develop overnight. It takes a while. The idea is that if you read the content of enough people, you'll be able to figure out who's writing what from a generic standpoint to be absorbable by a lot of people, right? Versus who's talking about things that actually matter, if I were to put it that way, right? Things that are differentiated. So it's not to say that most of them won't be valuable or X is valuable, Y is not valuable. So I think what you have to do here is to continue building that framework up yourself. What is it that you find useful? What is it that you don't? There's no one right answer to this again.
Okay. So, in your experience, what would be a better, what would be a more efficient way of approaching this?
Uh, and I don't really have an answer to what is the best way to approaching this, right? Just continue reading and Yeah, see where essentially the attention is and what kind of attention it is, right? If you see I think if you go through the comments, you'll find a lot of signals that can tell you what kind of content is being put out. If you go through it, you'll find out what kind of content is being put out. That's it. There's no more efficient way to kind of go about this process. I have deleted Twitter, I have deleted LinkedIn. So that tells you more. Yeah, that's one of my advice, right? Which is don't use these apps on your phone, use them only on the browser. Otherwise, you'll be suckered into a wormhole of content that you do not want to or need to be exposed to.
Yeah. Thank you for that answer.
Mohammed Fajr, you can ask next question.
No, I'm done. Thank you.
Hello, Madhur. I have one more question. So,
Yes.
Akul, ha- how do you manage your emotions? Like when, if you have invested in some company and the market is not supporting you, like it is very bearish and the investments goes down, how do you battle the emotion of like failed investment or something like that? Because that's what most people tends to face.
See, market is sentiment. Sentiment does not or should not impact you. What you're really trying to look for is um, what you're really trying to look for actually is just strength of the core of the business. So the market will impact you because any sentiment that's in public markets, in some sense, it percolates into private markets. We've seen fundraising cycles. There was one that peaked in 2015, 2016. There's one that peaked in 2021. We're already seeing signs of a bearish market. And that's good. But here's the thing, right? While the valuation bubbles go away, while the market may turn bearish, businesses built in these markets will always stand the test of time, which is businesses that typically get built after the bubble or during when the bubble is just about to burst or slash the markets are on a decline. They're the ones who actually raise the most amount of capital 5 years down. So idea is to like this is the right time to build a business. And for me as an investor, the idea is to um, it's hard because it gets to you from market lens, but try to shield yourself as much as possible in terms of opinions and believe in the founder, believe in the business, and believe in the product that they built. So that's the idea.
Thank you very much.
One last question from Sariq. You can ask a question.
Hello, Akul. So what I could understand from the talk was venture capitalism is the next step, even a further level of deep value investing. So like for 3-4 years, you would see no growth, and then just it will blast off. So in those 3-4 years, after you have taken a bet, how do you keep reassessing? What is your personal framework for reassessing the bet, whether it's going on the right track or whether it's not going on the right track? Because for 3 to 4 years, it won't be giving you any returns. So you can't just reassess your bet on the basis of returns.
Got it. Got it. Mm. So look, here's the thing. It's not really that after 3-4 years, it shoots up automatically, and there are no signs prior to that. What you have to continue looking for is progress happening, right? What I meant is that at least in most consumer companies, you can see, or even in SaaS companies, you can see a tip off point, which is the hockey stick curve, right? So you're growing steadily. Of course, it's faster than your typical growth at a late stage organization. But then there is that one pickup point, one event / one inflection point where the growth just accelerates and it's off the charts. So that is something you cannot predict when that's going to be. You're hoping for it every time, but you cannot see. What you're looking for, even at that point, is that the progress should continue, which is if today you have no product, 3 months down, do you have the product or not? 6 months down, do you have your first 1,000 customers in the case of a B2C product, or your first 5 beta testers in the case of a B2B SaaS product? So you're always looking for markers in terms of something that indicates progress to you. It does not have to be revenue. It does not have to be X number of customers, but the idea is something that gives you that proximity of progress. Did you hire a CTO or not? Did you hire someone in product or not? Has your team expanded or not? So there are multiple metrics that you kind of look out for, which will eventually get you to the outcome that you're gunning for. So in those 3-4 years, it's difficult, right, to estimate. I think it's difficult, but it is something that you have to contend with, in a sense that a business will show you progress. It's just not as quantifiable in a linear direction, because a business itself has so many legs. Some of it will progress at a certain point in time and the others may not. So that's what you're trying to look out for.
Yeah, got it. Thank you.
Madhur, I had a final question. Can I please ask that?
Yeah, okay, sure.
Okay, Akul, actually, so I'm reading this book from Sebastian Mallaby called The Power Law, which is about venture capital. And in it, in a chapter, he's speaking about the success of Axel, and he talks about a concept called adjacent possibilities, where he says that every time Axel would do a deal, they would not only invest in the company, but they would sit on the boards of the portfolio company and blend their observation with like a management consultant style analysis. So, is it something that you also like in your own approach? Is it important for you to also be sitting on the board of the portfolio company you invest in, or this concept of adjacent possibilities that every Axel would say that they want to invest in iterations of a specific product. So if he invests in a video conferencing startup in 1986, the next iteration, another company, he would also invest in that. So what is that approach? What do you think of that approach, and is it something you yourself follow?
Got it. So I think that's a look, anything that's been documented, it's too late to follow as a playbook, right? I'll give you a very simple example. Anything that you, after a building has been built and something different was done, does it get documented for a civil engineering student to be taught in a classroom? And after research has taken place, for research to be done, there has to be data, right? So anything that a fund has done as a strategy, something that's been documented, and now that it has been documented, let me tell you this, it's probably already too late to follow, right? But what I'll also say is that it's not particularly looking at the concept of adjacent possibilities. Sequoia did something else. They used to do, if X is true, then what else is true in that universe, right? And they would then take 25 bets on what else is true in that universe, which is also what they're doing today with Web3, right? If Web3 will become big, these are the 25 things that will be important. And so let's take a position in all of those companies. So the idea, I think, if I were to distill it, still remains adjacent possibilities is a nice term to be used. It's probably something that's catchy, but the idea still remains, is there a solution that's needed in this market? And what are the X things that the founder can grow onto? So that has become a standard part of the playbook. I think it's not called adjacent possibilities anymore. There is no better term for it. It's something that's so usual, which is, what is your product roadmap, right? Where do you go from here till here? What does a product possibility look like? Which is, if there is a new technological intervention that comes up, can you change the organizational DNA, or can you integrate that? So I think it all becomes a part of the way you think about investing today. So, and of course, board seats is a standard part of any agreement. So any fund that's writing a check into any organization, we do take board seats. So the idea that you're talking about of adjacent possibilities, I think it's the same question, which is just wrapped in a different toffee wrapper, essentially, right? It's the same thing, which is something that is available to you as an at a different point in time during your growth, right? And that will always be available. We're looking at it. And as a board member, you are giving them the right set of advice, hopefully, to help them capitalize on that opportunity. So you do consider it, but the market evolves so fast, you never know whether that's going to materialize. So yeah, that's what a board seat helps out with.
Hi, Isan. I also was reading the same book currently, and I think The person from Bloom Ventures also mentioned this book recently in his LinkedIn post. So would love to connect with you also over LinkedIn. I think we can wrap up now. Overall, on behalf of the entire team of the Finance Club IIT Patna, I would really like to thank Mr. Akul Jindal for such a truly insightful session. I am certain that each and every person in the audience took something very valuable from this session. Thank you.
Thanks for having me. All the best to everyone. And yeah, feel free to reach out to me on LinkedIn or Twitter. Cheers. Bye.
Akul, just one thing. I'll write a Twitter thread on this, so and I'll tag you also.